Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I think I've got something really interesting to share with you today. And just a bit of a warning or heads up, I like to mix up the podcast topics. I do a lot on property. A couple of weeks ago I did one on the share market, last week about tax reform. So I like to try and mix it up a little bit. However, I have to apologize because the next few weeks are very property heavy. But, the thing is with properties, there's been kind of a void of good quality analysis, I think. And so there's so much to sort of pull apart and hopefully it's really interesting. So I'm going to talk about long-term data and how we can interpret it and how useful it is today. Next week, I've got a podcast on property spruikers, how to spot a property spruiker or a property trend. And that's becoming a growing problem, I think, on social media, but it's always been an issue. And I'll share some of the sort of property fads or spruikers sort of situations that I've experienced or witnessed. Not experienced, I'll live through them, I guess that's experience, but certainly witnessed over the past 20 odd years. And then Campbell's got a really interesting one on land tax at the start of September, property management, we've got one on that, and a really interesting one that I'm currently working on, a metric that I think is really good to think about, which is return on borrowing capacity. Anyway, just a bit of a warning, the next few weeks are very property heavy, but hopefully, and my view is that if the content is interesting, people are interested, and it doesn't really matter if it's all sort of about the same asset class. Okay, so let's get into today's episode then, which is really about what does long-term property data tell us? And it's a common theme. In fact, I was listening to a podcast this morning when they were sort of talking about long-term property trends and whether they're sustainable, and I did an episode on that a few weeks ago. But, with ETFs, for example, or share style investments, quite often we go to the provider's website and we're presented with a variety of returns, short, medium, and longer term returns. Typically we get, what are the returns been over 1 year, 3 years, 5 years, 10 years? And there's always since inception. So which could be, if the product's been a long dated product like a lot of the Vanguard funds, you've got 25 years of data there. And I think all that data is useful for different reasons. So short-term returns, medium-term returns, and long-term returns, they're all important to weigh up. However, by contrast, media commentary with respect to residential property growth and trends and so forth tends to be either very short term and at best medium term. And it's always, it makes great dinner table conversation. What is the property market doing at the moment? Which market has been the best market over the last couple of years? Those sorts of things. It's interesting conversation. I get it. But I think the absence of talking about very long-term returns, I think creates a bit of a void of information and potentially invites investors to make mistakes. And arguably, with property, we should be more interested in long-term returns. Just because the entry and exit costs are so high and it's so illiquid, it takes a long time to buy and sell a property. Arguably, we should be more long-term dated in terms of returns and trends compared to ETFs. Now, of course, my view is that we should always make good long-term decisions, but, just talking about, shares versus property, it's kind of weird that there is a void of that long-term data discussion. So I have a table on the blog and the website. Of course, the link is in the show notes as always. What the table does is sets out 1, 3, 5, 10, 20, 30 and 40 year returns. And the returns are based on Real Estate Institute of Australia data, which gets feeds from all the state bodies, so Revy and Real Estate Institute of New South Wales and so forth. And it's for median house data as well. So that's the data that I've presented. And then I've looked at the median and average over the 5 largest states, being Sydney, Melbourne, Brisbane, Adelaide, Perth, just to give you a good sense, because the difference between the median and the average for those longer term periods is not very much. So it gives us, I guess, a better sense of the numbers. And then also in that table, I put in CPI, so just general inflation, because I think it's really important to look at what has growth been over and above inflation. Because there's some periods of time, like if you look over a 40-year period, inflation's been just over 3.3%. So it's pretty high, right? And when you look at median average across the 5 largest capital cities, it's about 7% in terms of return. So over 40 years, excluding inflation, we've got a 3.7% capital growth rate. That's pretty strong. Over the last 20 years, the growth rate hasn't been as strong. It's about 2.8% plus inflation, so almost a percentage lower than over 40 years. So we can see, and I think I did an episode probably last year where I compared the last 20 years to the preceding 20 years. We can see a difference there, and that's something we need to really think deeply about when we're making investment decisions. Now, when you look at the data over 10, 30, and 40 years, not so much 20 years, we've obviously got a period where we've had some pretty flat growth at some point over the last 20 years. It's not impossible to achieve a 7% growth rate. And I'm going to talk about the reliability of the data in terms of median data in a second. But I think we should put that in context because the success around property investing is about achieving the highest average growth over the whole holding period. So it's not about the highest growth over the first 5 years or something like that. It's really, if I'm going to hold this property for 10 years or 20 years or 30 years, whatever it is, I want the highest capital growth rate over that period of time. And so it's really important to understand, how returns compound. I've talked about this a couple of times in the podcast, but it should never get old because it's incredibly important to really think about, reflect upon, and remind ourselves about as well, because compounding capital growth will do all the heavy lifting with respect to building wealth. So if we think about a $1 million property that grows at 7% per annum, for example, now 7.2% per annum, your property value doubles every 10 years on average. So in the first decade, it goes from $1 million to $2 million. So $1 million worth of growth over that 10-year period, or $100,000 per annum. In the second decade, the property goes from $2 million to $3.9 million, which is about $190,000 per year in terms of growth if we're looking at averages. In the third decade, the property goes from 3.9 to 7.6 million, $370 per year. And in the fourth decade, the property grows from 7.6 to 15 million, $740,000 per annum on average. Now, $740,000 is a big number, right? But that's in 40 years' time. So in 40 years' time, not in year 31, but year 40, if my property goes up $740,000, it's really, in today's term, if we assume inflation's 3% over that time, maybe that's a little high, but let's say 3%, that's really $230,000 in today's dollars. So one of the challenges with getting our head around these numbers is two things. Firstly, our brain tends to think in linear terms, not exponential terms. Compounding is exponential, and it's very difficult for the human brain to get their head around it. Our brain is built around lower numbers, just from the explanation. Apparently, this is not mine, but, in terms of evolution, we were only just thinking about, there's 2 cows that I need to kill, or I picked 10 berries, or these sorts of things in terms of survival. So where our brain is hardwired to deal with small numbers fine, but not very large and certainly exponential numbers. And the other thing is we cannot underestimate the impact of inflation. But the impact of inflation, we need to think about it and put that in context too, because all inflation is doing is measuring purchasing power and looking at the parity of purchasing power. So in a way, do I care about inflation? Because, everything has gone up with inflation is the argument. So I get that. The thing though with borrowing to invest is that inflation eats away at the loan principal as well. So $1 million loan today is a big loan. $1 million loan in 40 years' time is going to be nothing probably. So the inflation eats away at the debt, but it also contributes to the property growth. But when we want to put our heads around these numbers, we need to really think about, the impact of inflation. It makes those numbers a little bit more relatable. The point of me sharing these numbers in this commentary is just to remind people that if we hold a property for 10 years, hopefully the capital growth is fantastic. But if we hold it for 40 years, the growth is potentially 7 times more on average per annum in dollar value terms in the fourth decade than it was in the first decade. And that's the power of compounding capital growth. And that's the power of buying a property that has the attributes to deliver the highest capital growth over a multi-decade period. The challenge with that is it's hard to sell, and that's why you get most of the market and most of the commentary talking about short-term growth. Because who doesn't want to go and buy in a location that is going to double in value over the next 5 years? I mean, everyone's going to put their hand up for something like that. Of course, that's a sexy, attractive thing. But what's less attractive is buying a location where it's just slow and steady growth over a 30-year period. The reality, however, is an investment like that is going to do most of the heavy lifting. Now, let's talk a little bit about median house prices or just median prices, whether they're median dwelling, median house, or median apartment prices. Let's just talk about the median as a measure. The median is really simply the midpoint of every property that's sold in a particular quarter. So, obviously, half of the properties in that quarter sold for more than the median by definition, and half of the properties sold for less than the median. It's really just the midpoint. It does not track like for like property over time. So, of course, it's going to be influenced by the type of properties sold in a particular quarter. For example, if there's a lot of sales of brand new or newly renovated homes, homes that's had capital invested in the improvements, not necessarily the underlying land value, it's going to skew the growth rate. If you get times where a market is really soft, like Melbourne, for example, over the last probably 10 years, typically in tightly held areas, people don't need to sell quite often. And so they won't sell in a soft market. They will hold out. And so therefore the properties that trade in what might look like an investment grade location or is an investment grade location, the properties that trade are either people that have to sell, people that don't really care about the price, or the price that they transact at isn't the most important thing. And there are a few people like that, right? It's a misnomer to assume that price is the most important thing to every vendor. And, just as a bit of a sidebar, it's always good to keep in the back of your mind, because when you're trying to buy a property, you want to ascertain, is price the most important thing? Because if it's not, we can negotiate on other terms and maybe get yourself a better deal. So really then, if we think about it, if we look at, the median house price growth over the last 30 years in Melbourne is 6.4%. So it gives us an indication where returns have fallen. But if we had a normal distribution, it's more likely that most property in terms of capital growth is probably plus or minus 1%. So it's really probably 5.4 to 7.4 in that range. And we need to really think about it. It's not just a perfect target. It's an indication of what property has been doing. Now, Coality has a daily price index, which used to be called CoreLogic. I think they're called Coality now. And they use a hedonic methodology. So it tries to compare like with like, and it looks at things like land size, number of bedrooms, these sorts of things. That to me starts to feel like more reliable data, because we are comparing more like with like. But what would be really good is to have a subset of comparable properties in a particular location and then track their sales over time. Now, you're not going to get enough data probably for that to be reliable, but that would probably give you the best indication of what the market's doing or what that particular market is doing. So having said all that, I think what we can do is use this long-term data as a useful benchmark. And if I look over the last 40 years of data, looking at both averages and medians over multiple capital cities, it becomes more apparent that probably a realistic benchmark is 3.3% plus inflation. If inflation, say 2.5%, and if we look over 10 years, it's been 2.8, 2.7 over 20, 2.7 over 30, and 3.3. So probably actually not 2.5. Let's go 2.7% for inflation. It means that 6% is probably a realistic minimum benchmark. In terms of if you're going to invest in property, only invest in property that you are absolutely convinced that will deliver 6% or more in terms of long-term average compounding capital growth over multi-decade periods. And I think if we use asset selection principles, that is finding properties that have a high land value component, that land is located in a location where land supply is finite and there's no access to, available vacant land in close proximity, and where that location is in consistently high demand, and also locations where there's got a strong track record of multi-decade returns. So really high land value, blue chip location, and strong track record, then arguably by applying those rules-based principles, we can identify property that's going to outperform the median. And I believe a realistic goal for those types of property is a return of 7%. So 7% plus inflation, or including inflation, sorry. And if inflation long-term, it has been 2.7, so let's go with that. So it's really 4.3% plus inflation is, I think, the realistic benchmark if we apply those principles. Now, that's not to say that investment grade property will always outperform any property in the short term. There's always going to be locations that do better than investment grade locations in the short term. And I say short term, maybe short to medium term, I should say, less than 10 years. But what we're most interested in is a property that's going to deliver 7% compounding over multi-decade periods. So if I buy this property, I'm going to get 7% over 30 years. And as a result, I'm going to enjoy the compounding capital growth that I just sort of talked about. Now, what I'd like to do is reflect on that table of returns and see what it tells us. Can we draw any conclusions on each capital city as a result of reviewing those short, medium, and long-term returns, which is really what I want to do, is demonstrate how we can use these returns to our advantage to make good quality investment decisions. So the first observation is over 20, 30, and 40 years, so they're very long term, Sydney has outperformed other capital cities by around about 0.5% to 1%. Now that might not sound like a big difference, but compounding over many decades, it makes a huge difference. And there's some obvious factors of why that might be the case. Firstly, it has a very large and growing population. It is currently the largest capital city in Australia, which means that it has a lot of employment opportunities, particularly for higher income earners and, executives and these sorts of people. The geography obviously is important as well. It's sort of landlocked by national parks and water. So it means that it limits the supply of available vacant land and puts pressure on density. So, Sydney can only really grow up rather than growing out. That said, the cost of entry is much higher than other capital cities. So you're going to need a larger budget, and that's going to lock a lot of investors out of that market. I think for an investment grade house, you're probably going to need somewhere between 2 and 2.5, probably closer to 2.5 than 2. So that's a big budget. Now, for some people thinking, well, do I want to put all my eggs in one basket? If you do have that budget, I think it's not only about returns, it's also about risk. And investing in Sydney, I think, because of the things that I just spoke about, very large population, great employment opportunities for higher income earners, and the geography, I think it's a very low risk market in that those fundamentals will continue to persist, and it's most likely that over the longer term that Sydney will outperform other capital city markets. But the key thing here is buying well. So if you compromise, buy a high enough quality property, you're probably not going to outperform investment grade property in other locations. So really, I'm just want to make sure that's clear that I'm really comparing investment grade opportunities. And the key thing here is Sydney costs more to enter. So if you agree with my benchmark, 3.3% plus inflation, or 4.3 as a benchmark that you want to achieve, then the Sydney, you'd have to reflect on those numbers and go, Sydney gives me the highest probability of hitting those numbers. Because investing is about risk and return. Can I get the return? This is the benchmark I want. I want 7% including inflation. Now, which market gives me the greatest probability of achieving that? That's Sydney, as long as you have the budget to get something that's investment grade. Now, unlike other markets, when you look at sort of shorter term returns, the way I look at those returns, I would say, look, Sydney's pretty fairly priced. So some markets, which we'll talk about in a second, have gone through a period of below average growth more recently, and some have gone through a period of above average growth, but I think Sydney's just about right. So I think if you went to enter the Sydney market right now, that's not such a bad idea. It's not like entering into a market after it's had a significant growth run, which we'll talk about in a second. But for example, Adelaide has delivered well above average returns over the last 10 years. And, I'd be cautious about entering that market, but I'll talk about Adelaide in a second. Next, I want to talk about Melbourne. Now, to say Melbourne has underwhelmed investors is certainly understating it. Over the past 5 years, net of inflation, so, taking into account inflation has lifted all boats, but property hasn't even kept up with inflation, that the median house price today compared to 5 years ago is 14% lower in real terms. And in real terms, there's been no growth, pretty much no growth over the last decade in Melbourne from a median house price perspective. And the reason I say that is the 10-year return is about 3% in terms of that's what the median house price has done. And inflation was 2.8%. So it's kept up with inflation and just exceeded it by a little bit, but essentially no real growth, which is a terrible outcome. But let's not forget, and this is the reason why we want to look at long-term returns. Between 1980 and 2015, So if we ignore the last decade, the median house price grew by 8.4%, which is really 1.4% too much. So even though we've had a very weak decade of performance over the last 45 years, so really from 1980 to today, the growth rate still comes in at 7.2%. So for those people that don't think Melbourne can ever recover or Melbourne will ever recover or provide the same level of growth that other markets has, my answer is it has over 45 years. Perhaps between 1980 and 2015, it got a little ahead of itself. It needed to take an extended breather if we believe in mean reversion, and I do, that everything reverts to the mean. And it looks like it's pretty close to doing that and it's ready for another growth cycle. Perhaps, I'm not guaranteeing it, but certainly over the next 10 years, the market's going to start growing again. And I think let's hope that that growth period starts sooner rather than later. And if you have a look at the Totality Daily Price Index over the last 6 months, so to the end of July, it's up 2.8%. So annualized, that's 5.8%. It's not shooting the lights out, but we haven't seen that index grow for a very long period of time. So perhaps that's a bit of a hint of what might be to come. On the demand side for Melbourne, the population growth remains really strong. So in percentage terms, it's equal with Queensland and just slightly behind WA in terms of population growth. But in absolute terms, in terms of numbers, Victoria added more people than any other state in 2024. In fact, more than 20% above New South Wales. And it's well understood that Victoria really isn't building enough houses to meet demand, and that not everyone that moves to Victoria demands a house in a new build location either, by the way. And I think that's a really important thing to note. Now, unlike Sydney, Melbourne has room to spread out the urban sprawl. And now that sounds like an advantage or really a disadvantage for investors because it does sort of change the supply-demand dynamics. It comes with a trade-off. Infrastructure just cannot keep pace with the geographical expansion of the city, and it causes a lot of congestion, long commute times, a higher living friction. It's just not as attractive to, live 40 k's away from the Melbourne CBD, for example. And over time, I believe that's just going to further strengthen and promote demand for inner city locations. Those with good access to employment opportunities that might centre in the CBD, amenities, infrastructure, all those sorts of things, the relative appeal of these locations only increase. And I know the challenges that, some of our team have. For example, one of our team members has to work from home this week because the trains aren't working. They've got replacement buses and it takes 3 hours to get in and back to work, and he doesn't live that far away from the CBD. So it shows that infrastructure is a real problem in Australians' growing cities. And so comparatively over the next few decades, those inner city locations, for those that can afford it, of course, will be more and more attractive. Now, some people might argue, look, Victoria's a high taxing state, particularly for property investors. And as a property investor myself, I'm not going to argue with that comment. But in a couple of weeks' time, Campbell's going to share some really interesting insights. And as a bit of a preview to that, in context, in comparison to Queensland and New South Wales, they're all as bad as each other in terms of land tax revenue. And one of them is even worse if you look at their forward estimate numbers. So over the next 4 years, how much revenue they project. Victoria is not the highest. So there's certainly been a lot of negative sentiment. And of course, Melbourne, Victoria has increased land tax and introduced that temporary, in inverted commas, levy. So I'm not arguing to say that it's fine, but really sentiment has been the cause. And if we have a look at the numbers, maybe we should all be dissatisfied with most of these states in terms of if you're a property investor. So let's talk about Brisbane next. Brisbane's delivered pretty strong and consistent growth over the past decade. If I have a look at its 10-year number is 6.7%, but if you have a look at its longer term growth is just over 7% over 40 years. So the last 10 years is just slightly under that, which sort of shows that that market still might have a little bit of steam left in it. But broadly speaking, it seems to be pretty much in line with longer term trends. So it doesn't look like it's an overheated market. As I said before many times, sentiment in the short run drives property markets. In the long run, fundamentals do. And Melbourne's a good example of that. As I said, the sentiment's been very negative over the last few years for good reason, in terms of what the state government's been doing for good reason. But the fundamentals don't necessarily justify that negative sentiment. Now, one of the big positive things driving sentiment in Brisbane is the Olympics. Everyone's talking about it. Everyone's saying, that Brisbane's prices are going to keep running because of the Olympics, and like somehow hosting Olympics just changes a property market. It brings forward infrastructure spend, it typically does, and certainly we're seeing a lot of that in Queensland and in Brisbane in terms of spending on infrastructure. I mean, they needed that investment because of their population growth anyway. So from that perspective, I think it does have a positive impact, fundamentally positive impact on property, but I don't think it really changes the long-term prospects. However, having said that, I'm not going to fight sentiment, and I think the sentiment will remain positive right through until 2032 when they host the Olympics. And then I would not be surprised if by 2032, so what's that, 7 years' time, we'll look at the numbers and go, Brisbane looks a little bit overcooked, and it might then go through another flat cycle. So if I held a property in Brisbane, I'd be pretty optimistic about the returns, probably at least over the next 5 years, but you can't expect the average return to continue at that above average pace. It's going to go through a bit of a slowdown, which is all natural, and long-term investors should be quite comfortable with that. That's how markets behave, and it's in our best interest for markets not to get too overcooked. So in summary, looking at those numbers, you go, well, Brisbane looks fairly valued, and we can see that the sentiment is positive. It's probably going to continue to run for a few more years yet. As I said just a few minutes ago, Adelaide looks probably the most concerning market. Over 5 and 10 years, it's delivered the highest capital growth of any capital city. And since 1980, when the data set began, so 45 years, the average growth rate is now 7.25%. So again, it's probably another example of sentiment driving markets rather than fundamentals. And in this case, positive sentiment. In terms of Adelaide's population growth, in absolute terms, it's minuscule. It's nothing compared to states like Victoria, Queensland, and Sydney. And with a population of just under $1.5 million, I mean, Adelaide just cannot offer the same depth of employment opportunities as those other markets. So it doesn't have the fundamentals to justify a 7.25% compounding capital growth rate over a 45-year period. Now, the thing with sentiment, particularly positive and negative sentiment, is it can run longer than anyone might expect. So never bet against sentiment changing, but it will change eventually. And I think if you look at those longer term numbers, if you're contemplating buying a property in Adelaide, as a general rule, just looking at these numbers, not specific properties, I would probably caution people. If it was me, I wouldn't buy one. It's a hard no from me, just because I think I'm getting in the market at probably towards the end, almost certainly towards the end of a growth cycle, and we know that we're probably likely to expect no real growth for potentially the next decade as a result of those numbers compared to other capital cities. And finally, let's talk about Perth. Actually put those numbers around in context. Adelaide's done about 12% per annum on average over the last 5 years, Perth 10.5%, so still pretty strong growth, but over 10 years Perth has done 4% versus Adelaide almost 7.2%. So you can see the disparity that both markets have had a good short-term run, but certainly Adelaide looks like it's pretty overcooked. And since 1980, so going back 45 years, we've got about a 6.8% capital growth rate compared to Adelaide's 7.25. So again, there's some evidence there that there is a disparity, particularly given the fact that Perth is recording 3.5 times the population growth in absolute terms. And so we can't get too excited, I don't think, about Adelaide from a population growth. And arguably that's the thing that's going to lift median house prices, because remember, it's the midpoint of all sales. So it's normal to see a very high level of growth in the early stages of a property cycle, but those percentage growth rates tend to sort of level out or moderate after the first sort of 5 years. So I don't think we're going to see double-digit growth in Perth over the next 5 years, but I think the growth rate will be above average, and I think there's still quite a bit of mean reversion left in that Perth market if we again look at those fundamentals fundamentals like population growth, which is very strong. I think there's still some good, strong fundamentals, and you can look at the longer term returns and say, well, there's probably a little bit of weight behind mean reversion as well. So I'm still optimistic about the Perth market. I think the next 5 years will certainly be above average. So there you go. Hopefully that's interesting. I think it's always interesting to look at these shorter, longer term, median, longer term returns, understand the data, and then really look into the numbers to identify kind of where markets are in their cycles. And these aren't perfect indicators, of course. They're not absolute, but they do give us a really good sense of trends. And probably one of the biggest mistakes I've seen property investors make, other than buying the wrong property, so the asset selection mistake, because that's number one. The other mistake is buying the wrong time in the cycle. So that is, if I'm a property investor and I'm agnostic about where that property is located, so I'm open to investing outside my domicile estate, then the mistake has been not picking the right state. And I think if you buy a great property, it doesn't matter what time of the cycle you buy it, you hold it for 40 years, you're going to do well. But the thing is that if you do well in the first 10 years or do better than average in the first 10 years, there's a compounding impact to that, because you can buy another investment property, you can gear into the share market, you can upgrade your family home, you can do lots of different things using those positive returns. Notwithstanding, it makes you feel pretty happy too that you're making some pretty consistent progress towards your financial goals. So, understanding those market cycles and trends is critical, I think. Okay, as I said at the beginning of today's episode, I'm going to talk about property spruikers next week, how to spot property fads, what are the commonalities between those things, and how to avoid falling foul of them. But until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.